Hello and welcome to this December 7th episode of your GoNoGo show. My name is Tyler Wood. I'm a CMT charter holder. And as always, or actually not always, but today I am joined by Alex Cole. How you doing, my friend?
Doing well and happy to be doing another GoNoGo show. We got run up into by Thanksgiving, but good to be back.
Yeah, 9 weeks on the road. It got to be a little hectic to film these weekly shows for you all, but we're back. It's December. Let's look at how markets are doing as we come into the end of the year and maybe share some thoughts on how we might react responsibly in the year ahead. Alex, as we always do, let's start with our cross-asset heat map. Look at some absolute trends across the asset classes.
Yeah, for sure. And you can see that we have been holding on to the Go trend in equities. That's the top panel, of course. We have seen a couple of weaker bars this week, but still holding on to the Go trend there. Treasury bond prices reacting with moves higher. And of course, those move inverse to rates. So we know that the Treasury rates are coming down. So Treasury bond prices going up. Commodities seem to have decided finally. We've been talking for weeks now about how commodities have been chopping around. They seem to have decided they're in a strong no-go trend now. We've seen some evidence of that across the commodity charts. And the dollar as well, still in its no-go trend. We're going to talk a lot about the dollar and rates and how this is going to affect equity prices probably in through the end of the year and into the start of the next. And then on the lowest panel here, we've got Bitcoin, which if you've been following that, has had a really strong move of late, back up over 43,000. So some interesting trends around the asset classes.
Absolutely. Starting from this top level perspective certainly helps us understand the context in which we are investing, the correlation between rising U.S. Treasury yields, strengthening U.S. dollar, and the seasonal weakness that we were seeing back in October in the S&P 500. Certainly, those headwinds wore off or blew away, which is not to say that they will forever be gone, but in the moment, seeing a lot of tailwinds for risk assets. So, Alex, let's just take a look at the chart of the S&P 500. We haven't been doing this show for a few weeks. Let's just review real quickly for everybody who's new to GoNoGo charts or who's just tuning into this show for the first time. We want to get a sense of the overall, the absolute trends, and those colors represent the algorithm in the back end, the weight of the evidence or that checklist approach using multiple technical indicators to give us a sense of the statistical likelihood and the probabilities for a trend to persist. So when we're looking at a go-no-go chart, those colors are represented on the bars. Blue and aqua are our go conditions. That's an uptrend, and it's in the strong or the weak form, blue, aqua, respectively. And then in no-go trends, we're in those pink or purple bars, pink being the weak form of a no-go trend, purple being strong form. And on occasion, at turning points, you'll see those amber bars, which is when all of the checklist, the weight of the evidence, is in its neutral category. And we know from Jesse Livermore that in all markets, there's a time to go long, time to go short, and a time to go fishing. So we have go fish bars. Sometimes that is the signal of the market. And that's the top panel, the price panel, where we really want to keep our focus. But we know that momentum and volume and volatility and all of those other aspects of the technical scene can be really helpful to traders. So we've got one panel in the bottom, the GoNoGo oscillator, which incorporates volume. We're a range-bound momentum indicator from -6 to +6, and we've got that very objective zero line. We'll talk about this on a lot of the charts today. Where we are in a trending environment, we're going to look for support at the zero line from above, trending in an upward direction, or resistance at the zero line from below when we're in no-go trends. So, Alex, S&P 500, we had a very fair and orderly downtrend through a seasonally weak period, almost to the minute. We entered November and markets rallied. Seasonality doesn't always hold as tight as it has this year. But we do know that when things are behaving in a seasonally normalized way, that's all fine and well. It's when they diverge from seasonal norms that we really want to pay attention. So orderly downtrend in September and October and back into go territory here in November. Where are we at right now? And what do we see in terms of upside resistance?
Yeah, well, I think what's important to know is we've seen this movement more sideways this week, and sort of from the end of last week and this week, not too many gains to be had. We saw some counter trend correction arrows. Okay, so those are going to tell us when momentum has moved to our overbought levels and then come back. So this is sort of a traditional icon that is going to give us a sense of exhaustion. So after that strong run, like you said, since the beginning of November, a little bit of waning momentum as price moves sideways. And what's that done is it has allowed the oscillator to fall to the zero line. So you talked about that objective level in our oscillator panel. We know that if a go trend is to remain healthy, then the oscillator should find support at the zero line and stay in positive territory. You can see all the way through this move higher here, the oscillator, when it falls to zero, finds support, rallies, and prices are able to continue to move higher. It's only when the oscillator fails to find support where we see that bigger struggle ahead. And so we're going to watch very carefully because we're looking for support now with the oscillator at the zero level. And you can see, if you just look at the crosshairs here, we're right around this level from our August or end of July highs. So we're going to need to try to sort of get above and then consolidate above those levels.
Absolutely. Let's switch this away from the daily view to a weekly view. Give our viewers a little longer context in terms of where we're at a current sort of resistance level, but really approaching those all-time highs that we struck at the end of 2021. So on the weekly chart, still seeing strong go bars, that blue colored bar from our trend model. We're seeing positive momentum at a 3, so it's not overbought yet at a 5 or a 6 level, but positive. And we're just seeing lighter volume as we approach these areas of resistance. So here through the year end, certainly we look to see trends continue. That daily chart testing the zero line from above, we'd look to find support there, and if not, perhaps the end of that trend will come. But Alex, let's turn away from U.S. equities. Let's take a look at some of those macro charts, starting with the TNX. We talked about a lot of Treasury bond buying, prices moving higher as the yields are rolling over. So this is the weekly view. That's perfect. Let's start here. And talk us through this chart right now. What were we seeing as a real moment of inflection with that GoNoGo oscillator?
Yeah, I think it's, we keep talking about how important it is that the oscillator finds support at zero in a healthy uptrend. Well, that's not what we're seeing now on this chart. You can see that in this weekly look, I zoom in a little bit, you can see that we've got these prior highs here that should act as support from the end of last year. But at the moment, creeping below those levels. There's also some support in between from the highs from earlier this year, but very, very important level because we see the oscillator breaking below zero. So if that leads to a larger correction, then we'll obviously look to the support that could be here from the lows from the late spring and then back, of course, to last year in the summer. So we've got the highs from last summer, the lows from this spring. But that's still got some ways to go. That's quite a drop if that was to happen. So if we don't hang on to the support that could be found here, we could be looking at a move lower on Treasury rates.
Absolutely. And let's zoom that into a daily chart as well, just to see what this week's price action has given us.
Yeah.
So when we shorten up the time frame, right, those counter trend corrections, the moves on that weekly chart, obviously with a shorter time frame, we're going to see those trend conditions change, and we're in strong no-go conditions on the daily basis for the TNX. Negative momentum, right? We came back and retested the zero line from below before surging back lower with enthusiastic selling. So that's the daily view. And again, when we think about areas of support and resistance, we're getting close right now to that area of what could be potential support. Below that, there's a lot more room to move to the bottom of that channel, and certainly that could be a catalyst for further gains in the S&P 500 through the end of the year. But Treasury rates aren't the whole story, are they, Alex? Let's turn over to a chart of the U.S. dollar. Here at GoNoGo, we love using ETF proxies because it gives us a sense of volume as well. So this is UUP representing the U.S. dollar index, and that incredible strength we had through September and October in those go trend conditions did finally roll over in November. Look at how that correlates with the gains in U.S. equities. So
Yeah.
a little less strength in the U.S. dollar. Certainly not a sharp downtrend, to reclaim or retrace all of the bull market move, but we are still in weak no-go trend conditions on a daily basis. We saw momentum, the GoNoGo oscillator, break below zero right there at the beginning of November, come back, retest, and was rejected lower. That trend continuation icon, the red circle above our price bar, indicating that momentum was resurging in the direction of the underlying trend. Right now, Alex, I'm seeing our oscillator in positive territory. Talk to me
Yeah,
about
this
that.
is going to be very interesting because the oscillator has edged its way into positive territory, but we also see that price is running up against resistance from what was support. So over here, at the end of this go trend, we found some support at these levels. We saw it happen here again, and then once that was broken, as you said, on the retest of the zero line from below, then we were off to a no-go trend that continued to move price lower. We've sort of rallied back quite significantly, really. But when we got close to that level, then we had a quick, sharp turnaround on today's bar. So it'll be interesting. This is definitely creeping into positive territory. Will it reverse and come back to the zero line right away? We'll have to watch and see. But it does seem to be finding some resistance there.
Absolutely. Now, we talked about the U.S. commodities index in a no-go trend as well, right? We saw yields rolling over, strength in the dollar ending and rolling over. Let's take a look at oil. USO is the ticker for an ETF, oil proxy on U.S. crude, and sure enough, we got strong no-go conditions with an extreme oversold reading. Correct? Is that a 5?
Yeah.
I can't quite see it.
Yeah, it's a 5, -5. And we did have, it looked to me like oil was sort of fighting at one point. When it kept coming up here, kept coming up and testing that zero line, multiple times there in succession, and we're getting that clustering of trend continuation. We've talked about that before on this show. I like to see that. Well, not like to see it from a opinion standpoint, but from a health of trend and likelihood to continue. I like to see a clustering of continuation icons. So given that we're in a no-go trend here, once we started batting up against that zero line, and we rolled away from it again, we see now we get a new low in price. So when we get that sort of clustering of continuation icons, it tells me that we've tried and then we keep failing to burst back into positive territory. So that then led to a sharp fall away this week. And as you said, oversold on the oscillator, but lots of heavy selling as well, lots of market participation, volume there, quite heavy relatively speaking, because we see the oscillator in a dark blue line.
Absolutely. Yesterday, crude futures fell over 4%, a 5-month low, under $70 a barrel. So certainly we're seeing the USO ETF tracking some of that activity. And within the commodity space, it's not all a bearish no-go story. Let's pull up a chart of gold, and we'll take this on multiple time frames just to get a sense of where we have come from versus where we are. So on the daily, Alex, walk us through what we're seeing from a trend perspective.
Well, on the daily, we've seen higher highs and higher lows. So that's exactly what we saw last week. We saw a new higher high, and then we saw counter trend correction arrows telling us that price may struggle in the short term. And that's exactly what's happened. We've seen some weakness then from GoNoGo trend painting aqua bars, and the oscillator's fallen sharply to test the zero line from above. So if this could well be a new higher low that we're looking at. And we'll look to see if that's borne out by support at zero, and then we'll sort of see what happens next. But if you want me to throw this out to a long-term chart, go ahead and do that.
Just before we do, you mentioned the counter trend correction arrows, and for anybody who's not currently using GoNoGo charts or just had a question about those, what we're looking for is the traditional readings on a momentum oscillator. So when we move to an overbought or an oversold extreme, what we're looking for in that signal is potential trend exhaustion. So when it pulls back or cools off or shows some exhaustion from an extreme overbought level, you'll see those red arrows pop up above price. It's just calling our attention to the fact that momentum has surged to an extreme and now is cooling off. So when we read the textbooks, momentum oscillators that are showing us those periods of exhaustion, it's not a direct sell signal, but it tells us that in the short term, price may struggle to move higher as it's got waning momentum or an exhaustion of that surge in momentum. Obviously, for portfolio managers who need to reallocate capital to other opportunities and get into other trends, it's a logical intermediate period high if you needed to trim back a position to free up some capital for other uses. So that's the context behind those counter trend correction arrows. We've been talking about the trend continuation, those circles below price as well. But as you said, Alex, multiple time frames. It's important to see where we're coming from.
Yeah, I mean, if I could, I'd go straight to the monthly. I mean, this is the this is the giant cup and handle that people have been talking about for forever. I mean, and I literally almost mean forever, as long as some people have been in the industry. I mean, this, what are we looking at here? 15 years, maybe 15 years really, but 12 years of this formation, right? We've had about an 8 or 9 year cup, and then we've had a very drawn out, extended 3 or 4 year handle. And if you can see, that is such a significant level. If you take this and just draw it straight across, you can see how many times already we've tried. And you mentioned earlier, Tyler, when we were chatting, that it's broken on an intra-week basis, but hasn't yet closed above these all-time highs. So that'll be very interesting to see what happens this week. We're sort of trying to do it again. But you can see that the support that it's putting in here, like it's a base within a base almost, right? Like there's this giant cup, and then usually the handle might be relatively small, or a lot of people looking at this area thinking that was it, but it's sort of stayed here. And if it eventually does go and consolidate above these levels, I mean, it could be start of something quite significant.
My young daughter, in attempting Taekwondo to break boards, sometimes it takes her 4 or 5 whacks to get through that. And certainly gold is taking quite a few whacks at this 2100 level. Intra-week, we have been above it. Yesterday closing just over 2,000 an ounce. And so, Alex, what's important about breaking out of a big level like this? Psychologically for investors, if we're at all-time highs, there is no upside resistance, right? We don't have another area that people are anchoring to as a potential spot to close out their positions. And so at all-time highs, you don't have that overhead supply and resistance, which means trends can persist quite steadily.
Very real. There's just nobody left to sell at that level, right? Like this, it's all upside potentially. So yeah, I mean, you know all the quotes from our old friends. The higher, the bigger the base, the higher in space. And when it's just taking so long, that the feeling, again, we try not to be opinion oriented. We try not to predict. That just has the sense, of course, objectively following rules and waiting for it to actually happen. But should it happen, the feeling is there that this has been setting up for so long that perhaps some gains for gold in the next years, 5 to 10 years.
And you make such a good point, Alex. It's irresponsible for portfolio managers to leave clients parked in gold for 4 years when it has done nothing, right? There are alternatives where you could find returns.
Because you think it's going to
correct.
Yeah, exactly.
Perma bulls or perma bears are not doing themselves a favor. Instead, we want to react responsibly. It's nice to see that there is a very tradable and very important level that we are at right now. And once above that, that could spell a great opportunity for investors. But let's move on from the commodity space. Let's take a look at a couple different charts of the equity index. So we looked through the S&P 500. What I want to pull up next is the XVG, which is just the value line geometric average. So we've talked about the S&P 500 potentially even making a run at all-time highs here towards the end of the year. We've seen this pretty strong rally seasonally through this month of November. But actually, let's start this on a weekly view, Alex, just to get a sense of what the bull market of 2023 looked like for the average stock. The value line geometric average is just taking an equal weighted approach to seeing what's been happening under the hood, not the S&P 7, but the S&P 493. And anyone who's been very resistant to the index rally that we have experienced has been pointing out to the thinness of breadth the fact that it's been a few mega cap companies really leading the way. And XVG is just another way to look at the equity index. And we certainly don't see the same kind of go trend in 2023. Instead, we see a really choppy range bound and really drawing lower highs and lower lows in the average stock of the index. What's interesting to note right now, right, in this final stretch of 2023, is that conditions have improved. So here on the weekly basis, we can see that it hasn't done anybody favors. But slip back to that daily chart, Alex. And here we're seeing the momentum breakout of a squeeze back into positive territory and back into go trends. Is this the time when we break above all of that overhead resistance? Who's to say? But we are seeing improvement in the average stock and seeing some of that rotation. We're going to get to the sector relative strength work here in just a minute, but wanted to point out what's happening there. And then Alex, similar looking chart, the IWM, just looking at small cap performance in the Russell.
Yeah, very
Talk to us
similar.
a little bit about what you're noticing here.
Yeah, very similar chart, of course, at the moment, because people have been quite rightly talking about how it's been the large cap, mega cap stocks that have been dominating the rally so far this year. So no surprise really that the IWM looks quite a lot like the XVG, but you can see how cleanly we've broken out of the downtrend. So this is what I would point out about a chart like this. When the no-go takes hold here, again, we've got the leading indication with the break below zero on the oscillator, and then the no-go takes hold. Now look at how cleanly that zero line has acted as resistance, which we know it should if the no-go trend is likely to continue. And then when it doesn't, it just doesn't quite hold here. It retests, we see a squeeze, and then it goes back into positive territory on heavy volume. And that's when we then see GoNoGo trend able to paint amber, and then, of course, aqua and blue bars. So just a very clean look at how on the daily chart the trends have changed. And we've had negative momentum, consistent rejection at the zero line. Now we're seeing positive momentum with support coming in at the zero line as we take off into this new go trend. So again, we've talked about this icon a couple of times today. This is a counter trend correction arrow. So it tells us prices moved fairly quickly in one direction. So that's given us some overbought readings. As we come back to neutral, this suggests that in the short term, prices may struggle to go higher. So what would we do? We'd look then at the zero line to see if we find support again. And if we do, while price sets in a higher low, then all good things and the trend may well continue. But that's what we'd be looking at next.
Absolutely. And I think it's important to understand that huge secular shift in U.S. interest rates, right? The fact that they've pulled back a little bit, cooled off, doesn't mean we're going back to zero. The sustainability of higher rates for longer is very possible. And so in that environment where most of our fund managers, most of the capital at work in the US equities market has never traded through a rising interest rate cycle. Remember, the last one was about 39 and a half years. If we are indeed entering that environment where it continues in that direction, then we might see very different leadership groups emerge within the equity space. And this is, I know it feels like it's been a long run since the COVID pandemic, but we're still in very early innings. And so looking at those multiple timeframes, looking at some very long-term charts can help you get a sense of how you might need to think a little bit differently. And certainly the passive investing infrastructure, the buy and hold strategies that have been so dominant in the advisory space for American investors, we could very well see this return to a stock pickers market, folks who are more tactical and who are getting more narrow into individual names. So with that, let's turn over to some relative strength work. Let's take a look at the S&P 500 on a sector group level, and we'll take each of the 11 spider sector ETFs relative to the S&P 500 as the benchmark. So instead of looking at just the absolute trends of all 11 sectors, we're going to look at them relative to the benchmark performance. And remember, S&P 500 is rising. So when we're seeing aqua and blue coloring for these ETFs, it means they are outperforming or outpacing the rising S&P 500. So Alex, walk us down the list. What are we seeing in those top two panels?
Yeah, I mean, those are your technology and your discretionary sectors. So there's some definite leadership from the growth. It was technology for quite a while, kind of with communications, which was interesting. And then what I found I don't want to say confusing, but what I found interesting is that we've sort of flipped between discretionary and communication. So
Correct.
I'm sure there's a reason for that, but still a couple of areas of leadership within the growth sectors. But coming into relative outperformance, there's definitely some more blue on the chart than there was, 2 or 3 or 4 weeks ago. So we're seeing financials continue to outperform. We've seen industrials come in. We saw materials try last week, but roll back over on relative in terms of relative performance. And real estate, of course, has been doing quite nicely for a couple of weeks. But if you don't mind, I would like to pull this out to a weekly chart as well.
Please do. Yes.
Because this is such a clear picture when you sort of slow down your periodicity just a touch, and you sort of say, okay, well, if we look at this relative to the S&P on a weekly basis, we're still seeing that this year's Go trend is dominated by growth sectors. So not too much change here, even though discretionary fell out briefly back in a Go trend. So the 3 sectors that are relatively outperforming, and if you'd have been investing in these since summer, since June, July, or even earlier with some of these, that's where the leadership has been. And quite clearly, you're staying out of the rest of these sectors. If you're trying to get a jump on things, then of course, like we just saw on the daily chart, some other sectors coming in now for some relative outperformance, but very, very clear when you take a time frame back that it's really been those growth sectors leading the way.
And for those doing tactical asset allocation work or just trying to get the sector bet right, I think you made a great point, Alex. On the far left side of the chart, as we entered 2023, the first things to roll over, right, out of the bear market conditions that we were in last year were the defensive sectors. We saw consumer staples and utilities close out and roll over. We then saw the cyclical sectors of the economy close out, roll over into no-go relative trends to the S&P. And it was at that point that we saw the growth areas of the market, information technology, consumer discretionary communications, take hold. And it has been the leadership groups all through the year.
Yeah.
So as we come into the end of 2024, taking a little longer look and thinking first and foremost about your asset allocation mix and where you want to be overweight. Certainly entering the next year, we'll be paying attention to what's happening with interest rates and the US dollar. But these kinds of relative strength maps are really helpful in just fishing where the fish are, or fishing where the fishermen are. I forget how the phrase goes. Alex, let's pull up a couple more individual go-no-go charts before we end today's episode.
Yep.
You mentioned the XLRE. Let's just look at that on absolute terms, because we are seeing relative outperformance of the S&P 500. But what does that look like? In fact, maybe we start it on a weekly basis,
Sure.
just so that we can see where we're coming from.
Yeah. So the weekly basis is actually perhaps more exciting than the daily because it's so new.
Correct.
And if you because again we've put everything in the background to get the sense of trend without putting anything on the chart. I mean, these kinds of trend lines kind of just jump out, right? So the break of the downward sloping trend line coming on color change to a new go as the oscillator breaks above zero on heavy volume. You got it all there, right?
You got it all.
1, 2, 3, 4. If you can answer those questions, you can say that we're in a new trend on the weekly basis on XLRE. And you can see it came off, it just bounced off that support. I mean, almost to the penny, right? The support from last October. So there's no surprise there. But then as it came and rallied each time, it failed at the resistance line, and not so this time. So a go trend, oscillator in positive territory, heavy volume. We're going to look to see if we can set a new higher high here on the weekly chart. And then if we look at what that looks like on the daily, then you can see, strong blue go bars setting higher highs, oscillator positive territory, heavy volume. So real estate's been a strong performer now for a few weeks.
And now I'd like to switch to a different view on the same kind of thesis. Let's pull up Homebuilders, the XHB, and we saw that that's closing above July's highs.
Yeah, I mean, we zoomed this chart out, remember, all the way, and now you're looking at one of those situations where there's not a lot above. Don't assume. I love this. This is one of my favorite quotes. I don't remember where I first heard it from or who told me first, so I apologize if I'm just.
I think I heard it from the great Dave Keller.
Okay, so there you go. So I don't want to take it from somebody without giving them credit, but don't confuse the top of the chart with resistance or the bottom of the chart as support. So right here we are, running out of room, but there is nothing above. And if you just imagine that your chart was more like this, right, then it can there's plenty of room. You see the interaction or the dynamics of web-based charting apps is great. So there is nothing ahead above this now, and you can see how we are in this strong go trend for XHB. And if you look at what this looks like on a weekly chart, then there's where that previous high is coming from, back at the end of 2021, and it's taken us a full year plus to get back there. Actually, 2 years to get back there, and here we are breaking on a weekly basis. And if we close up here, we're closing above those highs. So
closing at all-time highs.
Closing at all-time highs. Yeah. I
Very
mean, we were just talking about the cup and handle on gold. I mean, have another one, right? Here we go. We've got a cup and handle. Now, of course, gold took a lot longer with its handle, but if this one can close up here and consolidate, then you'd consider that pattern completed.
And I think the combination of having a rigorous quantitative methodology by which you're looking at the weight of the evidence, all of that context of classical technical analysis, understanding how important a key level is psychologically to investors, what it means to be at all-time highs, that just adds validation to, and perhaps some conviction to, what is a really robust and thoughtful quantitative methodology for trading. We don't want to. We know that we can look at charts and see patterns everywhere, and markets being fractal. That might be a 60-second bar, and it's important to give these things some context.
Can I go off topic just for a second? This is our first show in a while, but for those people that are of our sort of generation, I suppose you could say now, there was a classic movie, the one, what was it, Sixth Sense? Do you remember that one? Did you see that one? And the character would always say, "I see dead people," right? That was the quote. Yeah. And so when I teach this stuff, when I was teaching pattern analysis, I would say, "I see triangles," because they're there. And so those patterns pop out on charts when you aren't complicating them too much, and really you can call patterns all you want, really, but the right side of most patterns is some sort of triangle, right? This is an ascending triangle. It's a cup and handle, but it's also making higher highs and higher lows with a horizontal upper bound. So so there you go. That was another little anecdote or analogy that I like to say to people, because they're there underneath the chart. It's the market dynamics being reflected in the price action that allows you to see these things. But we want to get like you said, an objective, disciplined understanding of the technical trend, and then of course the rest pops out on the chart.
In the latest episode of CMT's podcast, Fill the Gap, we had John Kolovos on, and he said, with all of the very sophisticated statistical work that they do a lot of quantitative modeling, and he has been doing that for 30 years at multiple different firms. He said, my favorite multi-factor model still, and I run every investment idea through this final screen, is a two-factor model, my right eye and my left eye. And that if it doesn't make sense, if everything the model's spitting out doesn't look right in context, it gives you a moment of pause. You sharpen your pencil, you look at perhaps your models might be telling you something else. So
yeah, absolutely.
Alex, as always, it's great to be here on StockCharts TV. Great to hear from all of our listeners and viewers. If you have any questions about GoNoGo charts, by all means, reach out to Alex and I. You can reach us at info@gonogocharts.com. You'll see those links in the show notes below. If you're a StockCharts user, by all means, check out those ACP plugins. You just want to use the free trend module, that's available to you. The full suite of tools, as well as an ACP plugin. And if you've got some questions about those heat maps that we use with our institutional investors, please shoot us a note, info@gonogocharts.com. And until next week, take care of each other and trade them well.